Welcome everybody to the inaugural Storrow management video tutorial on the budgeting process. We probably should have made this video 15 years ago, but it's never too late to teach us old dogs new tricks. The purpose of this video is to walk you through the budget template so that you guys can do these budgets on your own. And the nice part about it is if you didn't catch something or you need to review something again, you can simply just go back in the video and watch it another time. So let's get started. It is now November, and we are working on the budgets for next year being 2021. I cannot wait. So why don't we get started? We're going to open our budget template, which I will send to all of you guys. And you'll see here that we have an Excel spreadsheet which has 4 tabs. There is the activity data tab. This is the tab which has a bunch of information which we're going to pull in from Center Shift. There is the year-over-year tab, which has a summary of prior year's P&Ls, 18, 19, the last 12 months, and then our budget. You'll see that generally across this spreadsheet, right now, everything just has a 1 in it, and that means we haven't filled it out yet. So it's not making a whole lot of sense right now with all these 1s, but as we get through it and start inputting the data, this thing will start to make a little bit more sense. Second, note that any cell which is a blue cell, the text is blue, is a cell which you're going to put information in. If the cell is black, you're not going to touch it. So essentially, you're responsible for the blue cells, not responsible for the black cells. The only exception to that is in the expense section of the budget. This is our output page. This is essentially the final product. When you get down to the expense section, I'll leave it up to whether you guys want to modify these black cells or not. So we have 4 tabs. The activity tab, where our Center Shift data comes in. The year-over-year tab, which is a comparison of our budget to prior years. The budget, which is essentially the output. This is the final product. And then the revenue projection tab, which essentially has calculations in it that feed into the revenue side of the budget page. So let's get started with the activity page. The first thing we're going to do is go to Center Shift. And for this, we need the 36-month report. Now, Gary, I realize that you use SiteLink, so the reports are going to be a little bit different. But the information in the spreadsheet should be fairly self-explanatory in terms of what it is. And so you should be able to go to SiteLink and pull this exact same information. It might require a little bit more manual entry, but I think you'll be able to figure it out pretty quickly. We're going to go to the 36-month report. And while this loads up, I'll tell you that it's important, this is very important, that we're going to go to the last day of the last prior month. Let me repeat that, the last day of the last prior month. So if we're sitting here and it's November 15th, which it is today, the last prior month was October, and the last day of the last prior month was October 31st. So we're going to go to October 31st. And we're going to be doing Rehoboth today. So, Rehoboth Beach. Let's run this. We want this in Excel, so it's easy to get into our budget. I'm going to click Excel. And voila. Now, the thing about this 36-month report, let's click Enable Editing so that we can work with it, is that it has some rows in here, essentially some gaps in between the years. And if you go back to our template, you'll notice that there's no gaps. So in order to make it easy to copy and paste, we're just going to highlight these gaps that we don't need and get rid of them. These are essentially just the gaps in between the years, so that when we cut and paste this, it's in the same format. So if we go back to our budget, you'll notice that the page starts with the numbers start with beginning occupancy. And we're only pulling, what is this? 6. 1, 2, 3, 4, 5, 6 rows of data. 36-month report has a lot more than that. So make sure when you go back to the 36-month report, you're only highlighting what you want to pull in, not more than what you want to pull in. And in this case, if we look at our beginning occupancy, well, that's the same thing as the beginning occupancy, obviously, on the 36-month report. So beginning occupancy, new rentals, terminated rentals, net rentals, ending occupancy, square footage occupancy. Well, lo and behold, if we go back to our template, that's the exact same order that these things are in. So it's very easy to copy and paste. We're going to simply highlight the numbers that we want to copy. There are those 6 rows. Go down to the bottom, Control C, copy them. We're going to come back over here. Now, this is important. You have to copy values, not copy all, not copy formats, not copy something else. We're going to copy values. So we're going to highlight this button, copying only values so that it doesn't ruin our formatting, and clicking OK. And voila, all of our numbers now here have populated. You may notice that under occupancy square footage, you just got a 1 here. Now it's black, so you don't touch it, but it doesn't make a whole lot of sense, and that's okay, because this requires us to populate some other areas of the spreadsheet before this starts. Okay, we are done with this page. Next, year over year. Over here, we need to pull in data from prior year's P&Ls. Now, this is actually pretty easy if you ask John Cullen to send you the P&Ls monthly in Excel. And we just happen to have that already, right here. So here's our Rehoboth P&L. And John Cullen can send this to you. And we're going to create a couple of columns. We're going to create columns for the past. We're going to create 3 years of columns. There's 2018, 2019, and then LTM, that's last 12 months. And now we are going to populate these columns simply by summing up the relevant months. So for 2018, pretty self-explanatory. They're going to go back to January 18, highlight through December 18, and there you go. 2019, not rocket science, go back to January of 2019, highlight through December 19, there you go. And lastly, LTM, that's the last 12 months. So if we start off in September, we'd have to go back to October 2019 to pick up the last 12 months. Now, the spreadsheet that you're going to be using is the last available spreadsheet. So in this case, since it's November 15th and John has not yet had a chance to produce the October financials, we're just going to use the last financials which are available, which as of today is September's. So that's why we're using September's financials. We're going to clean this up a little bit by getting rid of some of these decimal places and then just shift arrow down to the very bottom and then hit Control D to copy all this down, and voila, you have all of your information for these 3 12-month periods. Now, we might as well get this sheet into our budget because we're referring to it a lot. Right now, these are 2 separate spreadsheets. And so to do that, you're going to go to Format, go to Move or Copy Sheet. We're going to create a copy, and then it's going to ask us where we want to send that copy. Well, we want to send it to our budget, which is right here. And click OK. I believe the P&L should now be in our budget, which it is. So it looks the same as what we were just looking at. You'll now notice that it's now in a new workbook because these tabs are down here, which means we're working within our budget. We're going to just relabel this P&L. And we're going to drag that P&L right next to the year-over-year sheet. That's where we're going to be working. Now I like to keep my computer clean, so when you're flipping back and forth between screens, you're not getting all confused. So we don't need this old P&L anymore. We're done with it. We don't need the 36-month report anymore. Done with it. We don't need this management summary window anymore. Done with it. And I don't need this anymore either. Okay. Now, year over year. That is this tab down here. As I mentioned earlier, this is simply a sheet which pulls in prior year's historical, I guess that's what prior years means, P&L information. And right now it just shows a bunch of ones, which obviously doesn't make any sense. To get this populated, it's very simple. Go to the cell that you want to populate, hit equal, and then go to the P&L page. In this case, we're doing 2018. We're going to go to the P&L page. This is rental income, P&L. Here's the rental income. Here's 2018. We're going to put this number in right here. Next, other income. Same exact deal. Other income, 53,000 for 2018. Highlight it. Boom. Lastly, cost of goods sold. Now, importantly, with cost of goods sold, for some reason on the P&L it shows as a positive number, but it actually reduces income. It reduces revenue. So in order to make this work, we're going to put a negative in here. So equals negative. Go back to the P&L. Find cost of goods sold for 2018. There it is. Voila. Now, you want to check this as you go along to make sure that you didn't miss any numbers. Here we have 12,850. If we go back to our P&L, you'll see it's 12,850. So all is good. Now what we're going to do is we're simply just going to go across and do the others. So while we're up top, we're going to do 2019. And LTM. Remember, enter a negative for the cost of goods sold. See here, I forgot to add my negative, so I'm going to put a negative in here. And then we're going to check them. So 12,850, we already checked that. 12,850, 12,223, 223, and then we have 319, 319. So all's good in the world, and now we simply just need to put in the other data. Very simple. We're just going to cruise through this. I'm not going to want to do any talking while I do it, but you'll see on the screen it's pretty easy to do. You're just going to kind of flip back and forth between these screens to pull this data over to the year-end page, year-over-year page. You want to pay attention here because it can be a little bit confusing sometimes. It's easy to mess up the columns. You want to make sure that you've got the right year. doing travel, meals, and entertainment right now. Repairs and maintenance, 2018. LTM. Utilities for LTM. (2019) 2018. Taxes, LTM. 2019 and 2018. And then lastly, other general expenses, 2018, 2019, and LTM. Okay, so importantly, in order to make sure we didn't make any mistakes, we want to check the net operating income line and see that it actually matches the net operating income line on the P&L page. So we have 907,956 for 2018, 907,956 for 2018, 907,184 for 19, same deal, 907,184, and for the LTM we have 913,030, and over here we've got 913,030. So we linked it up properly. The last thing we want to do on this page is just make sure that this blue number up here is correct. In this case, it says September 30th, 2020. That's the date of the P&L that we're pulling in. And so this has already been pre-populated, but you just want to make sure that that date reflects the actual date of the P&L, which you're pulling into the spreadsheet. Okie dokie. So we are now done with this activity data. This P&L page, we don't need to come back, well, we will need to come back to it in a little bit, but we don't need to focus on it right now. That just sort of sits here for our reference. The year-over-year page has now been populated. This budget 2021 looks totally funky. It doesn't make any sense right now because we haven't finished the spreadsheet, which says negative $214,000 of income. That makes no sense, obviously, but that will change. The budget, again, this makes no sense because we haven't finished this, but this is our final product when we're done. And now we're going to move on to the revenue projections page. The revenue projections page is where the action takes place with respect to projecting revenue. So all the stuff up here feeds into these black numbers over here, which are our revenue items on our P&L. So you'll notice that up top, there's basically no blue very much at all, with the exception of the upper left-hand corner. In this case, we're doing Rehoboth, so we're going to label that Rehoboth. We're doing the budget here for 2021. That's already filled in, so we are all good here. Now, if we scroll down, you'll notice that there's some blue numbers to fill in. And we're going to start over here. We just got used to working with the P&L sheet, and we are going to go back to the P&L sheet again. And this time, we're pulling in LTM data from 9/30/20. Now, if this is 10/31/20, put in 10/31/20. But in this case, we've got the 9/30 P&L data. So we're going to do exactly what we had just done before. We're just going to kind of cruise this. So we're going to hit equal, go to rent charges on our P&L. There are rent charges, LTM, boom. Discounts. Here are discounts. Total income. So this is pretty self-explanatory. Here is total income. And we're just going to cruise through this. Rent write-offs. Here are our rent write-offs. Rent refunds. Fees charged. fees waived, fee write-offs, merchandise sales. Sure you get the right row, it can be easy to get the wrong one. Truck rental commission, right here. Miscellaneous income, here. Merchandise expense, here. And finally, credit card services. Credit card services is the one that's a little bit further down. And that's under other, general other, I believe. Merchant card services right there. Okay, voila. Now, the reason why we're pulling this information into this side of the spreadsheet is because this is used to calculate revenue going forward for some of the items which are not strictly related to rent charges. So, for example, if we were to look at merchandise sales, well, last year we had $6,000 worth of merchandise sales. We rented 331 units. And so the average sale per unit rented was 18 bucks. And so if you wanted to look up top, you would see that our merchandise sales line item drives off of the new rentals. And so for each new rental we get, we assume that we do an $18 merchandise sale. Some of them work a little bit differently, but basically all of these numbers are ratios or factors which drive off of other things in the spreadsheet. So merchandise expense will drive off of merchandise sales. Credit card services, 2.1% is the fee that we pay off of total income. So let's now move over to this side of things. Management software inputs. Okay, this is very fun. This cell here, you are going to be using the first day of the month that you are in. Important, I'll repeat that. The first day of the month that you are in. And so we're sitting here, it's November 15th, and so therefore we're going to use November 1st, 2020. All of this information comes from Center Shift, and in Gary's case, it will come from SiteLink. It should be fairly self-explanatory. So if I was to go back to Center Shift, I'm going to get this from the executive summary. And I'm going to put in, very important, November 1, Rehoboth. And we're going to process that. Okay, so all of the information you need is going to be right here in the middle. Now, Gary, I don't know where yours is in SiteLink, but in Center Shift, it's right here in the middle. And I'm just going to start typing these numbers in. So fairly self-explanatory. Total rentable square footage, that's the total size of our property. In Rehoboth's case, it's 98,000 feet. And rented square footage, that's also used. How many square feet do we have rented? Total units. Rehoboth has 634. Total units rented. Rehoboth has 609 rented. Gross potential. That's an easy one. You know what that is. Gross potential revenue for the whole property. Occupied units street rent. So in Center Shift, this is the occupied units under gross potential column. But Gary, for you, conceptually, this is how much rent would we be pulling in? All the occupied units are at street rent. And in Rehoboth's case, it's 104,000, 144. And lastly, there is the current. And the current rent is what are people actually paying today? And that is 107,554 in Rehoboth's case. Now, Rehoboth is unique in as much as normally they'll find that the current rent is higher then the rent if all of the occupied units were at street. But in this case, it looks like our street is actually lower than what a lot of our customers are paying, which doesn't surprise me a lot for Hobbit, but it is what it is. We'll come back to that topic in just a second. Protection plan. Okay, so the first is the plan price, the in-place price per plan average. And that is simply a calculation of the revenue which we are bringing in for the protection plan each month divided by the total number of plans. The calculation you'll need to use yourself. The current price per plan average, that is, what are we selling the plans for today? And if the vast majority of people are buying a $12 plan, I would use $12. If you have a mix of people, say, buying a $12 plan and a $20 plan, maybe you use the average of $16. So use your judgment here. This is essentially the average price of a plan that we sell on a go-forward basis. In this case, I'm going to be conservative and just assume that it's $12. Current customers with insurance. This is self-explanatory. If we go back to our executive summary, total insurance, 335, that's easy, 335. New customer penetration. Well, in Rehoboth's case, the total penetration for the whole property is 55%. So we might say, yeah, we're going to do a little bit better than we've been doing. Why don't we assume 65% penetration going forward? Use whatever you think is reasonable. And then lastly is the split to the property. John Cullen will have this information. Simply, how much take is the property getting compared to the management company? Now we're doing the insurance from the perspective of the property, and so therefore this is usually be 25%. John Cullen will have this information, but in all cases, 25%. Okay, we are getting there. The last section that we need to fill in is the leasing and other inputs. We have included over here LTM data for your reference. So the last 12 months period, we rented 331 units. The average monthly rental was 28 units, and the average vacate rate was 4% per month. If you were to go to the activity data, you will see all that information right here. Now, this is the section where we really use our judgment more so than a particular number from a report. And so, since Rehoboth is also really full at this point, it's running 96% in November, why don't we just start off by saying that we're going to rent 300 units next year, even though that's less than the 330 that we rented before. This is a black number, so obviously no need to fill it in. The move out percentage. Well, last year, 4% of the customers moved out on average. Let's say this is 4.25. Now, normally with a property, as it gets more mature, the move out rate goes down. But in this case, because it's so full, I think the calculation I'm making, and this is up to your own good judgment, is that we might get a little bit more aggressive on price increases because we're so full. And so maybe our move out rate ticks up just a bit. Promotion. This is the number of free months that we give to somebody who moves in. So if our standard promotion is, say, to give a free month, then you'd put a 1 here. If our standard promotion was to give 2 free months, then you'd put a 2 there. If it's to give no free months, and they just have to pay right out of the gate, then you would put a 0. Perhaps it's somewhere in between because you give a mix. Maybe you give half the people a free month, half the people no free month, and in that case, you put in half a month. So you put in 0.5. But in this case, I believe it's 1 free month. Admin fee for new rentals. I believe this is $22, at least in the US. And then here we have the rent increase on existing. This is the assumed rent increase that we're going to give to our existing tenants. Why don't we just start off by saying that's 5%. Lastly, we have the rent increase on street. This is how quickly are we going to increase streets. So for now, we'll just put in 5% just to get something in here. Finally, there's the management fee. This is calculated both as a percentage of NOI or a percentage of income. I believe that all our sites are only just a percentage of income. John Cullen will be able to give you this information, but this is usually 6%. And voila. So we have now finished populating this spreadsheet. And if we were to just pop over to our year-over-year tab, just to kind of make sure that things make general sense, we can compare our revenue to the last 12 months. It's showing that we're 7% above 12 months. Um, that seems to make sense to me. Our expenses are 4.8%. We haven't gotten to 4.8. Sorry, we haven't gotten to the expense section yet. I'll get to that in just a second. But you can see that this makes general sense. Our net operating income is going up about 7% prior year, and nothing looks too wacky. It's not like we're ending up with a bunch of negative numbers or numbers that don't make sense. So now that the spreadsheet is more or less filled in, we know that it's starting to kind of come together in terms of the outputs, and now it's just a matter of fine tuning. So with respect to fine tuning, just a couple of things to point out. Number one, go back to the revenue projection page. We want to make sure that nothing is getting kind of out of whack, especially with respect to the occupancy. So this property is starting off at 96.4% occupancy. That's where we are as of November 1. And you can see as we kind of move forward, we're going up to 97% occupancy, which would seem perfectly reasonable given where we are today. However, if you were to, as an example, put in, say, well, I'm just going to rent the same number of units that I did last year assumption, that would be 331. And then we go up here, you're going to see that we actually go above 100% occupancy, which is, of course, unrealistic. So what you're going to want to do as you're thinking about your revenue assumptions is to kind of tweak these numbers based on what you know about the property. And in this case, we might say, well, look, we're going to get more aggressive on pricing. I mean, it's the only way we can get more aggressive on pricing. We can't get more aggressive leasing more units. We're going to run out of space. So if we get more aggressive on pricing, perhaps we rent fewer units than last year. And perhaps because we're pushing rents on existing customers, our vacate rent goes up a little bit. And maybe we even make this 6% something a little bit more aggressive, just to sort of like reflect the reality of this particular property, which is it's practically full in the middle of November, which is the slow season. Again, after you change these numbers, you're going to want to go up here and kind of check out the occupancy percentages, make sure that nothing too wacky is happening. In case it looks pretty normal, you might want to pop over to the year-over-year tab and make sure that this is pretty normal, which it is. So this is what you can sort of, finesse as you're going through this little section right here to zero in on what you think is the right combination of rentals, move-outs, and price increases for that particular property. Lastly, let's go to our budget page. As I mentioned earlier, this is the final product, and you can see that all of the information here has been pulled in from this revenue projection page, which we are just working on. Now, it's a good idea to just reality check this stuff, right? Because you don't know if you maybe made an input error without maybe just going to a couple of these rows and seeing if they make general sense. So you might start by, for example, going to discounts. Well, we're showing discounts here of anywhere between sort of $3,000 and $6,000. It looks like. Well, does it make sense or not? I don't know. Let's go back to our P&L. Let's go up to our discounts, and you can see here they're ranging kind of from $3,000 to $6,000 ish, and so that makes some sense. Maybe you do a couple other checks. Let's look at let's look at fees waived. Well, fees waived and fee write-offs were not very much, around $70 or so, around $900 per year for each one of those. And if you go back to your P&L and you look at fees charged and fees waived, fees waived and fees write-offs, you're just about $800-900. So this is kind of making high-level sense. If you see something which is totally out of whack, then you're going to have to go back and figure out the reason why. Last, we haven't talked about expenses very much at all. That's where you guys come in. There's not a lot of fancy formulas or anything like that as it pertains to expenses. You're simply going to want to fill in this information. And the exception on the expenses side of things is that if the number is black in here, you guys have permission to fill these numbers in black. This is really up to you. You are going to want to both be mindful of the historical operating performance of the property to make sure that your projections make sense relative to history, but also mindful of maybe how things have changed. Let's say we added another full-time staff member, and we're planning on keeping that full-time staff member forever without having gotten rid of anyone, and just the new normal is that you're going to have one extra staff. Well, then you're going to want to make sure that that's reflected in your personnel costs. And that might show that it's considerably higher than historical, but that's okay. Things have changed. So once you get through populating this stuff, you want to be frequently referring to the year-over-year page, making sure that things make sense, and ultimately, after you tweak it, you will finalize this budget, the final output being this. So hopefully this is helpful. I think that you guys should be able to complete all the budgets. Like I said, Gary, this is a little bit different just because you're pulling this information cycling, but I'm sure you'll be able to figure it out. And that's it. Let me know if you have any questions. Thanks, guys.